Good evening, ladies and gentlemen. Thank you so much for joining us for the first ever CNBC-TV18 India Exchange. I'm Shireen Bhan, and on behalf of the entire CNBC-TV18 team, we're so happy that you could join us here. It's a working day, and I know that it's not easy to take time out from work as well as your evening routine and spend your evening here with us. So we truly appreciate it, and thank you so much for joining us here this evening. So what is the India Exchange about? A couple of things, actually. We decided that since it is the 25th year for CNBC-TV18, it was an opportunity for us to bring together thought leaders, market experts, people who join us day after day on the channel to really create intimate evenings where we can look ahead, but also get some perspective on what we've been through as an economy and as a nation over the last 25 years. And that's what we're attempting to do. The overarching theme for this evening is the decadal dividend. Everyone's talking about how this is going to be India's decade. So our question to our panelists here, and we have many experts joining us here this evening, will be exactly that. What's the bull case for India? What is the thesis that they're working with? What will drive growth? What will capital chase as we look out at the next 10 years? But as Steve Jobs said, we can't connect the dots looking forward. We can connect the dots if we look backwards. So just to put some data points on the table, if you look at the last 25 years, and 25 years only because, as I said, CNBC-TV18 is completed 25 years this year, the Nifty has seen an annualized return of 13%. If you take a look at the period between 2014 to now, that's 10 years of the NDA, annualized return for the Nifty about 12%. If you look at the 2004 to 2014 period, 10 years of the UPA, an annualized return of 16%. It is election season. We're talking about what could potentially be the next trigger as far as our markets are concerned. And again, if you just look at historical performance, May 19, 2019, 6 months prior to the elections, we saw the Nifty up by 6% and about 5% post the next 6 months after the elections. And similar story playing out in 2014, in 2009, and in 2004 as well. So as we look ahead, we are going to, of course, ask our panelists to explain to us how they see the macros. And Samiran Chakravarti is here to kick things off this evening as he maps the macros with us. We have the two Manishas, Manish Chokhani and Manish Kejriwal joining us as well to discuss where the markets are going to be headed. And of course, as I pointed out, where capital is going to be moving. Are we on the cusp of unleashing the animal spirits that everyone's been talking about and everyone's been waiting for? Is it going to be an investment-driven growth or consumption-driven story that we will continue to see? Those are some of the questions that we will have our panelists address here today. It has been, for all of us at CNBC-TV18, a record-breaking 25 years. We are good at what we do, but that's not the important part. The important part is that we try and be better at it every day, and that's what keeps us going in our newsroom. So once again, on behalf of CNBC-TV18, thank you so much to each and every one of you for joining us today, for your support over the last 25 years, and we look forward to many, many more. Thank you, ladies and gentlemen. Without further ado, to kick things off, mapping the macros, Samiran Chakravarti, the stage is all yours. A big round of applause for Samiran Chakravarti.
Thanks, Shireen, and thank you, CNBC, for giving me this opportunity. Am I audible? Yes. You know, at times when the markets are doing so well, the demand for economists typically come down. We have a demand curve which is inversely proportional to the markets. So I'm just wondering why even CNBC gave me this opportunity to speak today. We are in high demand when the economy is not doing well. But today is a time when I'm going to just simply, that's why I choose 4 random questions. And I will try to give you my version of answers to those 4 questions, because I think most investors are asking me these questions. So let me first put the questions in front of you just to whet the appetite. So the first question is that the way the global economy is shaping up, is it a tailwind for India or is it a headwind for India? The second question that I want to attempt is India's growth too hot or too cold? The third question I'm going to attempt to answer is that, would RBI cut interest rates at all? Why? And the fourth question is that, and this is something which just happened today, that at a day when equity markets touched an all-time high, why is it that the currency touched an all-time low? So over the next 20 minutes or so, I'll try to delve into these four issues. So first, on global. Look, just a few months back, I used to say that everything around global is turning out to be good for India. Now, it's a bit mixed. So what is good is that global growth is not falling off the cliff, as a lot of people would have worried. Even in Citi, our house view was of a very slow global growth year of less than 2% global GDP growth. We have upgraded that a bit. The second factor that was a big positive to start with was that interest rates globally would be cut significantly. The market expectation was that Fed will cut about 125 basis points or so. Now, it appears that because of the slightly higher growth and slightly more resilient inflation numbers, the expectation of interest rate cuts have come off. The market expectation is about 75 basis point rate cut, but for all practical purposes, now people are confused when and how much rate cuts are going to happen. But apart from these two, the most important thing for India has always been commodity prices, particularly oil. And this is the new development which is slowly being baked into markets, that oil prices has creeped up to $90 per barrel. I am no expert on geopolitics to tell you exactly where oil prices are headed. In fact, in Citi, our house view is that oil prices will come off from these levels. But just in case oil prices go up, let me give you the sensitivity of India's macro to oil prices. So the sensitivity is that about 10% increase in oil prices leads to about 15 basis point decline in India's GDP growth, and about 30 basis point increase in India's inflation, and about 0.4% of GDP increase in India's current account deficit. These numbers are not scary, particularly given that we are starting off from a very stable macro and growth environment. But the big but is that globally, the favorite trade for investors is to short Indian assets whenever oil prices go up. This is an instinctive reaction. And I'm worried that when a particular threshold of oil prices are reached, there could be some negative effect on investor sentiment regarding India, not as much a worry on the macro factors of oil price impact. I'll not have time to delve on two issues globally, but I think from a medium-term perspective, which we have to be worried about, which is that how this huge increase in global public debt is going to be unwound and how emerging markets would be impacted by that. And the second issue is connected to it is about global liquidity. In my view, global liquidity is still very ample, flush. When this liquidity is tightened, how that impacts EM assets is something also we need to understand. So that's broadly the global backdrop. If I quickly move on to the second issue of, is India's growth too hot or too cold? The debate starts from these two concepts that economists use of GVA and GDP. As you know by now that our GVA growth is around 6.5, and our GDP growth is around 8.5, and everyone is scratching their head to figure out how this 200 basis point of gap can be explained. I think it's a useless debate. Economists will like the GVA number because that's how the data is collected. But it's also true that for years together, we have been using the GDP growth number for policy making, for our commentary, everything. So just because the GVA number today is what fits our perception does not mean that we can change the metric and move everything to GVA. So I suspect that policy making will keep on happening on the basis of the GDP number, not on the basis of the GVA number. But even if we believe the GDP number, it's quite true that it's a two-paced economy. Two-paced because the investment side of the economy is doing significantly better than the consumption side of the economy. Investment is growing at double digits for 3 consecutive years, which has never happened in India's history. And consumption is the weakest that we have ever seen, barring crisis periods. I have a strong suspicion that the consumption numbers finally will be revised upwards, but be that what it may, there is still going to be a gap. The issue, and Shireen mentioned this, that whether India's growth will be consumption-driven or investment-driven. If you look at last 2 decades of India's strong growth, consumption used to provide 400 basis points of GDP growth on an average every year. So if investment was growing at 8–10%, we would easily get 7–8% growth. So it's important for consumption to come back to that level of 400 basis point contribution to GDP growth. So the optimistic spin to this is that the investment growth that we are seeing now, that will create the jobs, the income, and the demand and the consumption with a time lag. The pessimistic story is that if demand is not picking up, then ultimately the investment side will also suffer, private capex growth will not happen. And that leads me to the investment side itself, where there is a two-pace. Two-pace because the perception is that public capex is driving the entire investment growth and not private capex. When will private capex pick up? But interestingly, if you break the investment data, only 25% of investment comes out of public capex. 35% of investment is private capex, and 40%, the largest part of investment, is actually household capex. And household capex, in turn, is mostly real estate. I would argue that the public capex and the household capex is what is driving our investment growth now, with some support from private capex. But over a longer term, my sense is that we will not go back to the 38–39% investment to GDP that we had seen in the past. We are utilizing sweating capital much better than what we were able to do. Our productivity is much better. So even with somewhere around 35–36% investment to GDP, we should be able to generate the right kind of growth for us. And then lastly, within consumption, there is also a view that there is a K-shaped consumption. The top-end consumption is growing better, the bottom end is not as much. I suspect what is going on here is that the cumulative inflation over the last 4 years have been more than 30%. So people who have got income growth of more than 30% are able to cling on to the consumption basket, grow their consumption. But people who have not got that kind of income growth, that's where the consumption growth might have suffered. There is one trivial way of presenting this through urban versus rural. I'm generally not too much in favor of that. In India, it's difficult to break this up in a watertight way. But going forward, our sense is that there are some headwinds developing on the urban consumption front, where there are some tailwinds developing on rural consumption. So maybe this gap will converge as we move forward. But overall, if you look at it, the RBI is most likely to increase their growth forecast for next year. Would probably be around 7–7.5% growth next year. But the big question, and I'm not going to give an answer to this question as such, but just put it up in front of you, is that should we be happy with 7% growth? Why? Because of this unique conundrum that we have now, that given our demographic dividend, which is going to last, in our view, for a decade, should we be aspiring to grow at closer to 10% to get the maximum advantage of this demographic dividend? Or should we be looking at the global growth at 2–3% and say that in this turbulent period, if we can get even 7%, 7.5% growth, that's good enough. I think depending upon which view you take, the direction of policy could be very different. You would have to be much more radical in your policy thinking if you aspire to grow at 9, 10%. 7%, 8% growth is a very conservative policy approach, according to me. Let me quickly move on to the third topic, which is, should RBI cut? Again, there are three aspects of rate decision. One comes from growth, one comes from inflation, one comes from financial stability. As we were just arguing, India's growth is more or less fine right now. There's no need or urgency to cut rates for supporting growth unless you believe in my thesis that India needs to grow at 9, 10%. So a little bit of support from monetary policy is warranted. The second aspect is inflation. Big dichotomy in inflation. Headline inflation is still much above RBI's target of 4%, but we are consistently seeing core inflation numbers to come off, which shows that monetary policy is working. But I suspect that till RBI sees actual headline inflation coming closer to its 4% mark, they will wait on rate cuts. And the third factor is financial stability side, which is a luxury to delve into when growth and inflation are fine. If growth inflation was not fine, we would have seen everyone talking about growth and inflation. But because we are cyclically in a good position, this is probably the right time also to build buffers. And maybe that's one reason why RBI might delay the rate cut. In Citi's house view. We think that the first rate cut happens only in October and not before that. But RBI has already ensured that the liquidity in the system has improved compared to the last 5 months. The overnight rates have come off, the short end of the rates have come off, the so-called stealth 25 basis point of rate hike that had happened, that 25 basis point of rate hike has been rolled back in some sense. So this is the first step of monetary policy easing, which RBI has already embarked upon. The second stage will be when RBI will be changing the policy stance from withdrawal of accommodation to neutral. Our sense is that somewhere in the middle of the year, and then with a couple of policies gap, we might actually see the first rate cut coming. The reason we are often asked is that why RBI is different from other central banks. Why is it that Fed will cut and RBI will not cut? The big difference is that most of the other central banks are working on this rather vexed concept of real policy rate. You will see that most central bankers are saying that real policy rates are too high compared to what those economies are used to. In the Indian context, with our current expectation of about 4.5% average inflation for FY25, our real policy rate is around 200 basis points, which by Indian standards is just fine. It's not too high. So there is no urgency on RBI's part to cut rates based on real rates. Whereas if you look at US, in US a year real rates are probably 300 basis points now, given where their rates are. And by their standards, 300 basis point is a very high real rate. So that's why it's possible that RBI will not match the Fed one for one in their rate cutting, and Indian rate cutting cycle might be a very shallow one with about only a 50 basis point rate cut. And my personal belief is that the impact of rates on India's growth is overhyped. India's growth is much more structural in nature and does not require this small cyclical support from the central bank policies. I'll go to my last point, which is about what I was saying, the difference between how the equity markets are doing versus how the currency markets are doing. My sense is that India's external sector today is probably the best health that we have ever seen. Why do I say so? Because if you look at current account, you'll be surprised that for the January-March quarter that just went by, current account in India should be in a surplus of about 1% of GDP. We are used to 2% of GDP deficit in current account. Now we are running a current account surplus. In fact, our projection is that for the foreseeable future, India's current account should be less than 1% of GDP. I should touch wood somewhere that oil prices don't go up to $100, then all these forecasts will go for a toss. But if oil prices stay somewhat benign, we are now entering a period of much better current account than we have ever seen. And that's because our service exports are really going up. In fact, we will not be surprised if very soon our service exports will match our merchandise exports. In fact, you'll be surprised that our IT exports are now reaching the level of Saudi Arabia's oil exports. That's how large our export side has becoming. So current account is turning out to be very good. On top of it, we might be flooded with capital flows next year. One, because of this bond index inclusion, which in our view could easily bring in $30–35 billion of inflows, much more than what the mathematical way of looking at it. The debate is more on FDI. As some of you will be aware that the FDI numbers have been coming off for the last couple of years. I would argue that the decline in FDI, partly it's global in nature, but partly it's also because there has been more outflow of capital from India. The gross inflow number has not been impacted as much. In fact, we have our ways of web scraping data to figure out the FDI intent into India. And I would say that from 2023 onwards, the intent of FDI into India for the first time has crossed the intent of even FDI into Vietnam, which was the case earlier. So I'm somewhat more comfortable to project that the FDI numbers going forward would improve. On top of it, this current account improvement and the portfolio flows should give you a massive BOP surplus of $60–70 billion next year. But the but is that there is no correlation between balance of payment surplus and currency in India. In last 10 years, there has been only 1 year of currency appreciation, while all the years have been BOP surplus. So this is the meat in the market that if you have a BOP surplus, the currency should appreciate. It doesn't work like that. Currency depends on two things. One is inflation differential. Our inflation differential with the rest of the world, if it increases, then the currency needs to depreciate to match that. This has been the case in the past. We have an inflation differential with the rest of the world, and that's why the currency typically depreciates. And the second thing is about RBI's view on what the true valuation of the currency should be and how much intervention RBI is doing. RBI has of late demonstrated that they want an extremely stable currency. We might ascribe motives on this. We might say that this is a precondition for rupee being internationalized, being used as a denomination currency in trade, maybe. Or it could be because of keeping our global borrowing costs low by having a very stable currency. But whatever it is, this seems to be a big driver of why the currency has been kept where it is. So while we might argue that, look, the rupee has reached an all-time low today, what gets missed is that if you look at 2024, rupee is actually the best performing EM Asian currency. So sometimes just looking at the USD INR rate, we might get a very different impression of where things are versus the actual reality out here. So let me quickly summarize some of our house views just because I was asked to put the numbers there. So we think GDP growth of close to 7%, maybe a tad lower. We think inflation in India next year should be about 4.5%. The first rate cut maybe in October, but when we get the signal of that rate cut, 10-year bond yields should start coming off. So we are projecting a 10-year bond yield of about 6.5% by end of the fiscal year. Currency, a very narrow range of about 2% between 82.5 to 84. And overall, I would say that I would end by saying that India is in the right position right now to start expecting on preparing for a 8 to 10% GDP growth rather than a 6 to 8% GDP growth, which has been the story of the last decade. Thank you again for the opportunity. Thank you.
Well, thank you, Mr. Samiran Chakravarti, for that fabulous summary of the state of the macroeconomy, and to target for an 8 to 10% growth and not be satisfied with that 6 to 8%. And of course, your view that there is no need for a rate cut. I'm sure bankers like Mr. Vaidyanathan will agree, because bankers love high interest rates. But the rest of the market really has been clamoring for a rate cut for private capex to really pick up. I'm wondering if you had any counter question to pose to Mr. Chakravarti, Mr. Vaidyan.
Samina, that's a wonderful speech. I think all of us really appreciated it. If India targets, say, 10% instead of the 7% going on right now, is there any, what are the safeguards India will have to do so it doesn't overheat and go into inflation mode?
Thanks, sir, for asking me this question, because it gives me an opportunity to present my macro framework to you. My macro framework is that historically, India's supply curve was very fixed. And whenever demand used to go up, we used to hit that supply curve. It used to turn inflationary, higher current account deficit, currency depreciation, and the cycle used to turn. Now we have the opposite problem. Our supply curve is very flexible because we are doing a lot of investments. But the demand has not picked up as much. So this gap between supply and demand is actually causing core inflation to come off. So inflation is coming off quite materially. Current account is not a problem at all. Currency is not a problem at all. So we now have an opposite problem of how do we create demand so that we move this demand curve up to that supply curve. So at this moment, given where things are, I think we need to throw out our baggage of the earlier cycle of thinking that whenever we will have higher growth, that would cause these inflationary current account currency problems. If we are able to do that, we will be able to run a more radical policy than what we are doing currently.
Well, we have some of the market veterans sitting right here, Mr. Ramdev Agarwal, Mr. Prashant Khemka. Any questions for our guest?
What is the reason, most of the economists, they are getting the growth rates wrong? And as much as by 1.5%. Even RBI economist has got it wrong. I don't know whether you got it right or wrong.
So, as I was mentioning that, we economists, we love the GVA number, not the GDP number. That's how we forecast things. And if you look at it, the GVA forecast for economists came almost in line with the GVA release of the government. The gap between GVA and GDP is this somewhat vexed concept of net indirect taxes. To be honest, we have not been able to figure out where this net indirect taxes data come from and how this is exactly measured. And that's why in quarters, when the GDP data, this net indirect taxes grow by 32%, it becomes impossible for economists to predict that. Our GVA forecast was 6.6. The GVA came exactly at 6.6. But the GDP, we were forecasting maybe 6.9. GDP came at 8.4. That's how the problematic part is. And, but I must admit saying that I can't, on the basis of that, suggest to policymakers that shift to GVA. Why? Because historically, for many years, we have been tracking the GDP and making policy on the back of that. Just because in 1 or 2 readings, my GVA and GDP numbers are not matching, I can't move back to GVA. That's also not a practical suggestion.
Okay, well, I'm going to take it over from Ritu, and I'm going to toss it over to the audience. If anybody has any questions for Samiran, we're going to go over to this gentleman here. Yeah.
Yeah. Samiran, if one looks at the subsidy numbers for October, December last year, they were 1.5 lakh crores. And this year, I think they mysteriously come down to 75,000 crores. And all of us know that the government accounts are kept on not on accrual basis, but on cash basis. So, I mean, just to play devil's advocate, I think if I want to jazz up the GDP numbers just before the elections, this is the last print, I believe, the one that we got. I think if you have that 75,000 crores of gap, which even if I just pay on 1st of Jan, instead of paying before 31st December, that explains a large part of the difference between GDP and GVA. And those numbers are available, sort of, in the public domain.
So I know exactly where you are coming from. The problem is that we used to have this proxy indicator of net indirect taxes, where we used to calculate the gap between the indirect taxes and the subsidy and the growth rate of that. Till COVID times, that proxy indicator used to work very well. Post-COVID, that proxy indicator is not working that well. So I would say that the problem is not for this quarter. In fact, perversely, this quarter, if I had used my proxy indicator, I would have got exactly the same result as the government has got. But because we lost trust on that proxy indicator, we are not using it anymore. Maybe going forward, we will start thinking about it this way, but whether the government did not give subsidies in this quarter and gave it in fourth quarter just to show the GDP numbers in good light, that's a question which I am in no position to answer.
Samiran, thank you so much for that absolute masterclass as far as mapping the macros are concerned. Please give him a big round of applause. Personally, I think I'm going to sort of download that episode back when I'm home and watch it again. It gives us such a solid framework to analyze macros in India, really. Our next session is a very interesting one because we're moving away from macros to markets, right? And we're calling this a jugalbandi between two market masters. And they are really market masters in the true sense of the word because between them, they've got some, I think, at least 80 years of market experience. They've seen the highs, the lows. They've seen crises, they've seen booms, busts, really experienced it all. I'm talking about Ramdev Agarwalji and Manish Chokani, who are our next panelists. And this jugalbandi is between them, no pesky anchors in between. Ramdevji, really, I mean, actually, both of them need no introduction, but I'll just say a few words. I think Ramdevji is someone who is a passionate investor. He's got a childlike enthusiasm for ideas. I mean, I remember the first time that I met him, I came back with a list. And it was not a list which was basically made up of stocks or themes or anything. It was a reading list. So I consider Ramdevji first and foremost a teacher, a mentor. And his message to me and I think others over the years has been read every day and, you have a hope to succeed. So Ramdevji, thank you very much for your wisdom all these years. Really appreciate it. Manish Chokani needs no introduction either. He's one of the most astute market investors that we have amidst us. His grasp on macros and markets and distilling the macros to the micros is, I think, unparalleled. He simplifies complex ideas guided by first principles, and I think that is where he really excels. So without further ado, let me request both Ramdevji and Manish to take the stage and, dare I say, entertain us with his jugalbandi. Over to you guys.
This is the scariest thing we've done, completely unscripted. And then Ramdev went and put his foot in his mouth asking him about economic forecasts. What if they ask us about market forecast? He only missed by 100 or 150 basis points. We get it wrong by 10 percentage points.
But at least we can say we don't know.
So we can start off. I was at pains to tell Sonia that you're 10 years older than me. So you should you should have the first bite of the cherry, and you should kick off on maybe as Shirin introduced in the beginning. You connect the dots backward. So how the last 40 years, because you've been there, I think, since the 80s. I came only in the 90s. So maybe, no, I say it with, not in jest, but because he saw the kind of 10x of the index in the first decade, and then the mania of Harshad Mehta and how that played out. And we may well be setting up for that. So I think we are both in sort of that camp. Maybe I'll leave it with you.
So actually, it's a terrific time to remember 1992. I mean, I have seen firsthand, actually 85 was the first boom, which was VP Singh and Rajiv Gandhi combined. And that was a kind of mini boom. Just stock market just doubled in 1 year. So that was a small. And then came the 1990-92 boom. I think it is
He just said the market doubled in 1 year, just in passing.
But just listen to the second one. When the index went 6x from 700 to 4200 Sensex in 19 months flat, that gave birth to Ramdev and Moti and into Motilal Oswal. So I started with zero money. I mean, zero, literally zero negative rather, and we made 30 crores in 19 months. And that became the seed capital for Motilal Oswal. Wonderful. So, yeah. Then came the next bull run was the Y2K bull run. Then came the GFC, the commodity bull run, rise of China. It was actually rise of China, commodities and everything. And then we had little lull and then pre-COVID. So my sense is what I've seen in 1992, this is 10x of 1992. We are into seriously very large bull run. The issue is this time there is a SEBI. There is an RBI with a complete digital system. They actually can see what badmashi we are doing. So with the police, the crowd will be a little limited, little disciplined. So my sense is eventually we'll run much more, but it will be a little prolonged. So my sense is that this is I think this is a retirement time for us. If this bull run,
for you, I'm 10 years younger.
Yeah, so you'll see another bull run.
So as Prashant said, I'll just supplement. As he said, it's useful sometimes to give context in which this is happening. And Keki will know this well also, that when we broke the Bretton Woods standard and the US started basically printing money and we all pegged to the dollar, every decade we had a mania in some market or the other. So in the 70s, you had the Nifty 50 in the US with the Disneys and the Kodaks and all. Sorry, that was 60s. 70s, then it goes to commodities, which is gold and silver and all of that. And the famous Hunt brothers. 80s, it went back into commodities and emerging markets. So that was the rise of Japan and Taiwan. And all these manias go up 10 to 15 times in 1 decade. Then we kind of got the tail end of that, of the 80s end, which really was Japan, Taiwan. And Harshad Mehta, I think, decided he wants India to participate in that. And the 90s, of course, went back to tech and US and the NASDAQ. And then the 2000 to 2010 period came back to commodities and emerging markets in which India, China all benefited, and that was the rise of our great bull run as well of the 2000s. The last decade, again, we saw 2010 to 2020 going back to financials, technology, the FANG mania. And that's why the supposition for most investors in the world is, again, this decade comes back to commodities and India. And to Samiran's point about how do we play this game this time? And fortunately, RBI keeps coming and keeping the market cool from the debt side, and SEBI is doing a great job getting the froth down, because what you don't want is all the returns to be front-ended.
Yeah. Don't have parabolic market.
Yeah, and then you have 20 years of a bear market which follows. Yeah. So if we
go up,
if we go 10 to 15x in this decade, that would resemble what happened to Japan in the 80s and what happened to China.
No, even India, 92 to 2002.
Right.
So that was a very bad period.
Yeah.
So
that's a good cue for you to now talk about the retail investor and the rise of retail in India.
So why I'm saying this is that rise of retail investor and the force of it, people have still not, now people are getting sense of it, but they have still not understood. Till 2020, we are getting about 300 to 400,000 customers per day, per month. and the industry as a whole. Come COVID, digital onboarding starts, no physical checkup for onboarding. In five minutes you start your trading and all. And we start getting 4 to 5 million customers per month. 4 to 5 million customers per month. From 40 million demat accounts, now we have clocked 150 million. And I think this is 3 years story. And when you imagine 5 million customers a month, and these customers are cumulative in character. They're not flow, they are cumulative in character. And we are headed for maybe 300 million straight in 3 to 4 years. And maybe, I don't know what is the end game, maybe 10 years of 500 million. So this is a amazing stock market boom. Stock market liquidity inflow into the market. Now what it does is, of course it lifts all the stock prices, mid cap, small cap, large cap, anything goes. And last year, I think 23-24, the return for across the portfolio, at least in my AMC and what I invest in generally, is about 50% across the portfolio. I'm saying, I'm not about one scheme or one stock. I'm talking about the entire portfolio, extremely diversified. Literally, I bought the market. So that is 50%. So you imagine the kind of bull run which is underlying, despite all the restrictions by SEBI, regulators and everything. So, and we have still done 150 million. Now you imagine people, when it was 50 million, the 50 million satisfied customers were there, and they were saying, brothers, come and enjoy the bull run. Now there are 150 million customers saying, boss, this is fun, lot of fun, please come. So you are getting not a smaller number of demat accounts, you are getting larger number of demat accounts. I have never seen in my office somebody coming and saying, sir, I have 500 crores fixed deposit, what do I do? Or 1,000 crores fixed deposit, what do I do? So this is the kind of shift which is going to happen from fixed deposit to the mutual funds or whatever, stock market.
The investment cycle is back. It's not happening on the ground, it's happening in the stock market.
What is going to happen is, my sense is, one is that stock prices are up. Then what happens is the supply response comes in. There's a demand response. Now there is supply response. So all the IPOs, you're seeing 50 times, 60 times. Then QIPs. But put together, they're just about 1 lakh crore. 1,25,000, 30,000 or something. The actual flow is almost 5 to 6 lakh crores and growing. So there is still, this year is second, third year, this is still excess demand, then supply. So I don't know how fast. I would expect government to at least divest 1 lakh or 2 lakh crore worth of stuff immediately after the election. Obviously don't expect before election. And so after election, and the larger corporates like Jio and all those big ones which are waiting in queue, 50,000, 1 lakh crore kind of IPOs, let that come. I think we are going to see all of them coming in. So I think the supply response should come, and that will broaden the market in a very healthy way. And so the fun will become even bigger. I hope that is what happens, but anybody's call.
No, it's again consistent with the phases of market which we see, where the profit cycle starts in one sector, then it spreads to another sector, then the P multiples expand, and then we start creating new stories and paradigms. Like 15 years ago, it was BRICS will be the new engine of the world. We are setting ourselves up to say India is the only large economy in the world of this size which has growth ahead of it, not in the rear view mirror.
What is the investment theme? I mean, you are very good at...
So there are 4 or 5 things which, see, we are just copying what's happened in other countries. So it's nothing unique. We've all trod the path before. And if you look around the world, typically, as again Samiran was pointing out, when you get richer, you don't buy FMCG goods, you buy consumer discretionary. So you spend more money on improving your house, you'll spend a lot more on property, you'll spend on travel, you'll buy a better car, you'll do all your home improvement stuff, you'll go out to eat. So consumer discretionary is one very, very, very big play. Housing, of course,
so you start with that, but do you think it will never trickle down?
No, it will obviously, because each time when you build a home, there are 5 people who are supplying and 10 people who are servicing you. And India has this unique pyramid of that 2% Australians, 18% Filipinos, and then maybe 1 billion people living in Africa, and it will trickle down. And if I then see the math, for example, 20 years ago we were selling 1 million cars, same as China. We are barely crossed 4 million today. China is at 26 million cars. We sell something like 12 or 13 million air conditioners. China is at 220. So that's the scale of change which lies ahead of us in the next 10 years. So that's of course one. Second is, as the government privatizes effectively to the private sector. So you've seen effectively Reliance and Bharti have run the telecom infrastructure of India, and we couldn't have run the country in COVID if this wasn't there. Or Adani now runs the ports and the airports of India. Indigo, pretty much, Indigo and Tata will run the airlines of India. So all of these privatization beneficiaries will become very, very large. The profit size is very, very large over here. So that's item 2. You and I may not participate because these are not traditionally high return businesses, but you're getting the likes of Blackstone and others to come in. They're taking over even the commercial properties and building REITs. So that's kind of item 2. Item 3, I know we all enjoy doing the Zomatos and all of the world with the internet-enabled businesses can become very, very large in the country. And like you said, in your own field, the rise of Zerodha or even Angel and even yourselves, with what happens with the rise of internet and making life so easy for people, it just explodes the business. And I think we've been beneficiaries of that in our life as well. That clearly is number 3. But the biggest mega theme, and I'm sure Keki and Vaidya will talk about it, is financialization. We are a $4 trillion economy. We save 25%. There's $1 trillion of saving every year. Of that today, only half comes to financial assets. Half is still going to physically buying real estate or gold. So first of all, that has to get financialized. Within that, the share of the banking system has to become much, much larger. And I'm not going to do this because I'm sure Vaidya and Keki will do it.
Banking system will be larger?
Significantly larger. Let me give you one good stat. And although I know, you have a AMC and we both love the mutual fund business, but just for context, HDFC Bank today would be what, a $60 billion net worth for a bank which is 20% of India's banking system. And let's say it'll be a 600 billion odd balance sheet size. If you are saying this country gets to 5 and 10 trillion, and let's say we only want 15% compounding, which is 4 times. So HDFC Bank needs to get to $240 billion market cap. At a $240 billion market cap, $240 billion net worth, it will be a $2.5 trillion balance sheet, which is still very, very tiny for a country of this size in the context of a $10 trillion economy.
But do you think, yes, size will increase, but do you think the economics, will it be in their favor? Because
it will be, because like I said, you're taking share away from real estate and gold, then you'll take away share from public sector banks.
What about actually bank deposits going to the stock markets?
So I'm glad you asked. So let's again take the same math. The biggest mutual fund today, and I'm just rounding off, I don't want my friend in SBI to be unhappy, but let's say HDFC mutual fund is a $10 billion market cap. And let's say you want to compound at 25%, so you get to a $100 billion market cap. At a $100 billion market cap, at some point he will sell at 4% of AUM, more or less, which is what the world average is. Today it's priced for perfection. To get to 100 billion, now you multiply that by 25x. So he needs to be $2.5 trillion AUM. It's impossible. Whatever you do, it's not going to happen. So mathematically, you will make a better return in the bank than in the mutual fund, while the business will do better in the mutual fund. It will compound faster, but you won't make a stock return in it. As an example. And I wish Navneet well, I don't want him to come and beat me up, but both are friends. And I own both businesses today. But like I told you in our last Diwali interaction, that you will be 10x in 10 years.
But what we have seen in
the amounts are minuscule. And Vaidya is what? He's 30-odd thousand crore net worth today. And he's guided, so I can share it publicly. He's saying I'll grow 25% for 5 years. So he'll be 3x in 5 years. At that point also, he's 90,000 crore net worth.
No, I'm not doubting your figures.
It's a drop in the ocean.
What I'm saying is a shift, the pace at which people are shifting their bank deposits to stock market side.
Yeah.
If
I'm glad Nilesh just walked in. He missed all the mutual fund numbers.
So what I'm saying is, if by chance there is a 17-18 lakh crore accretion on the bank deposit side.
It's too tiny. That's what I'm saying. It's a trickle.
Listen to me. And just about 5-6 lakh crores on the mutual fund side or entire stock market side. If that goes to next year, 10 lakhs to mutual fund or capital markets, and deposit accretion only is 18-19 lakh crores. Then what happens to the cost of deposit?
You see, it can be a circular argument. We can argue it won't happen and therefore the cost will go up. I'm just giving you the aggregate numbers that banks may be 80%, mutual funds may be 20%. Over time, the mix will change. but the country is still compounding at a certain rate, and you're still taking away share from real estate and gold. So it's not one is winning at the expense of the other. And I'm saying mutual funds will compound 25%. Banks need to only do 15. The end point trajectory still, you cannot imagine a HDFC mutual fund at 2.5 trillion at that point. But you can imagine it for the bank. It's a done deal. So I'll just leave it at that.
But the valuation can be instead of 4%, it can be 8% to the...
I'd not argue with.
What I'm saying, we can keep arguing the numbers.
Sure.
Yeah, okay.
Yeah, sure.
Let's move on to something else.
So, why don't you pick? I think all we agree, we are extremely bullish on, life. We both think there's a bubble possibility forming in India.
The real issue is what all can go wrong. Yeah. Because we're all born bullish, Parma bull and all. But a lot of things can go wrong. It will go wrong. But what are the things you see going wrong?
See, I've had this line for long that whenever you want to be bullish in India, you look at the business and you find all the reasons to be bullish. Whenever you want to make a bear case for India, you look at the macro and you'll get very, very bearish. But we've gone through Kargil, we've gone through coalition governments, we've gone through COVID, we've gone through everything. Somehow, the miracle of our country is the entrepreneurs are great. The sense innate of business is great. You may get a 1 or 2 year break or a 6-month break in your investment returns. But eventually the power of profit and the compounding of profit is what has given us our returns. If I look back to when I started my life, again I remind you 10 years after you, the profit of Reliance Industries was 150 crores. That's all in 1991. They are north of 80,000 crores now. They have seen US put sanctions, Kargil has happened, COVID has happened, this has happened, that has happened. See where they are.
But do you think supply, because the valuations are not unreasonable, but definitely demanding. Do you think supply can overwhelm the demand side in terms of paper supply?
See, again, it's a matter of horizon that if it depresses the market now, you will say this supply is creating the investment cycle because if I raise 2 lakh crores of equity,
if
foreigners sell 2 lakh crores of debt.
If foreigners sell
sure.
another 5% of their holding,
right.
Then you can get enough 5 lakh crores of supply.
Sure. But then the bull argument will be they will come back and buy it at 10 lakh crore valuation after 2 years.
They never come. Why? Once the market collapses, then they'll come.
Again, we're both bullish, so I know you're just being devil's advocate. The reality is, for any investor in the world, when you look at US, other than the magnificent 4 now, not even the 7, everything is in the rearview mirror. You look at Europe, nothing's going to happen. Japan, nothing's going to happen. China is already facing its own problem. So Larry Summers had this very lovely line. He said, Japan is a hospital, Europe is a museum, China is a jail. Where do you invest in the world? To paraphrase what he was saying. So if this is a $4 trillion GDP economy, which is almost inevitably going to be 10, 15, 20 over the next 10, 20 years, you would be stupid anywhere in the world to not come and make some allocation here. Today we are 3% of global allocation. If this country has to become 10, and I don't think we debate that, it's a matter of when it will happen, it's not if. For the other countries, it's a problem of if now. So yes, things can go wrong over here. Oil can go to 120 next year. There can be a war. China can go into Taiwan. He can go into Arunachal. He can go anywhere.
Let me ask you one more thing.
Can you delay the inevitable?
Do you think, in next 12 months, 18 months, the copper, because you are at 22, 23 times trade. I'm just asking Manish.
I can react to that then.
Yeah.
We did
listen to my question first.
I understood where you're coming. The question is, where is the... We had this lovely forward, I think some friends of, common friends with Nilesh, and he said if you toss a coin on a daily basis, your odds are 50-50. When you do the investment return on a 3-month basis, you may at best be 60-40. When you do it on your 1-year basis, it becomes 75-25 in your favor. If you do on a 3-year basis, you become 90-10. So to answer the question, a short run, this year, for the index, I don't think more than 5 or 10%. That's my view. We are expensive, no doubt about it. But if we are indeed so bullish, we think it gets to $5 and $10 trillion over the next 5 and 10 years respectively, the size of profit pool will be so large that we are concerned with companies that we sit on. I don't buy the index, neither do you. And all we are doing is we are buying odds that is it priced for perfection for everything, or are there pockets available to me where I can invest? And then for each person who says, I can supply and depress the market, please remember my friend Manish is also here, who's just raised another big private equity fund, he keeps bringing fabulous companies then to the market. Just as an example, you got, I think, AU, Manyavar, all these fabulous companies to the market. You are part of that as well. So one side there is supply of old, and other side there is supply of new, and there's reason to be optimistic about it. That's all. I can't be a blind bull like our old friend Rakesh, that at all time 360 days we are bullish. It is tempered. The valuations are not cheap, no doubt about it. But if you take a longer term view, and when I look back, 30 years in my case, we were $275 billion GDP. We are at 4 trillion today. The size of profit pool of India was what? What was our foreign exchange reserves? Where are we today? Whenever you are in doubt, like in global financial crisis, you wake up in the morning, slap yourself, think of the problem of a rich uncle in the world, but hold on to your portfolio. I know we are trying hard to find bearish things, but maybe we'll ask Samir any bearish reasons for. But, the reality, what he says, right, that when we are also optimistic, the prices are reflecting that. So we're confident about the economy, we're confident about corporate sector, we're confident about our savers, but this price is representing a cheery consensus. That is also there. Yeah. If something very bad, unexpected happens, it can cause a sharp sell-off, but I still think this becomes a buy the dip market rather than a sell the rallies.
Manish, Ramdev, it was an excellent discussion. We really enjoyed this. Jugalbandi, this is what we had planned for, right? Very impromptu, everything for the audience to. I'll go to the audience and ask a question, but before I go to the audience, I have a personal question to ask Manish. You spoke about India moving towards $10 trillion economy. It's an inevitable. It's only a question of when. In this whole context, where do you or Ramdevji look at the PSUs? Because that's where the whole investment seems to be. A lot of retail investors are very heavily invested in the PSU stocks. If both can answer that question on the PSU investments.
You go first. Yeah, I think this PSU category, categorizing the companies as PSU, non-PSUs, I think that thing will get blurred in the sense that now there is a company and a company. You decide on the basis of, don't put a sticker as a PSU or non-PSU. And there are bad PSUs, there are good PSUs. So if there are good PSUs are there, the capex companies, asset-light companies, defense companies which are monopolistic in character, obviously as the defense Indianization happens big time, clearly they are going to be beneficial and it will be loved by the market. But there are very bad PSUs also. So just because it is PSU, it is not a good company. And just because it is PSU, it is not a bad company also. So I think going forward, I would look at it on a merits rather than PSU or non-PSU. Yeah.
Manish, you have a view on PSUs?
Yeah. Are you carrying this live?
Yes, we are carrying it live.
Okay, then I won't say certain things. So, I own SBI as an example. That I think it's inevitable in banking, HDFC, SBI, they will not compound at the fastest rate, but they have to be a core part of whatever you're holding and seeing ICICI Bank and all these. They're just long runway to go over here. But to a short point, what I was hesitant to say, I'll try and rephrase it better, that the lack of the investment cycle in India is a lot to do with two things: the insolvency and bankruptcy code and the end of telephone banking. Because a lot of projects which came earlier, the equity of the promoter came through the project itself. So project cost of 1 became 1.5 miraculously. So that showed up in capex numbers, which suddenly has vanished. And 2, people got phone calls to put up more capex, whether it was PSUs or through the PSU banks. Because that governance structure has got cleaned up, I think the market has caught on to it. So whether it is the banking sector, whether it is the individual PSUs, they always held dominant positions, but they were misused or they were not run for profit. And one thing which this government has done is not just come and run the administration better, but also ensure that the PSUs are run better and they are accountable. In fact, if there's a lesson which is to be taken from China, they have held now the PSUs there accountable for stock returns. So that's the next leg which should come here to give you the next leg of re-rating over there. So I'll pause at that. You remember my conversation, Ramesh and I used to always love PSUs as well.
Nigel, you're in the audience as well. If you want to reach out to some people and ask questions.
Yeah, that's right. But just one question before Manish as well as Ramdev ji. Modi ji 1.0, Modi ji 2.0 are very good. And we're ready for Modi ji 3.0. What could be on your wish list?
Oops. That he comes back with 400.
Yeah, but in terms of...
No, see, there are few things which has been held back. For example, the farm laws, the labor reforms, the administrative reforms, judicial reforms, and the acceleration of this cycle, I think has been held back for various political reasons. If he gets enough leg room to push those through faster and accelerate us, like he said, to go to that 8-10% growth, it cannot happen in the absence of labor laws, getting people out of agriculture, getting urbanization, skilling them. So all that is something which small things add up, and that gives you the takeoff to the 10% growth number.
It's like
so I'm quite hopeful that this government comes and does that, and they leave our capital gains the way it is, and not increase that.
Yeah, so it's like the batsman in good form, a couple of good innings, and now all set to knock it out. Ramdevji, you?
Yeah, I think one of the things which most of the government miss out is the power of wealth creation by the stock market. The capital market, I think last year, has created upwards about 120, 130 lakh crores on a GDP of about, say, 300 lakh crores. So we are talking about upwards of 35% of GDP. When the GDP goes from 7.5 to 8, there is a headline. You imagine 35% of GDP you have stuffed in the pockets of all the guys. I mean, mostly in Mumbai, but...
no, UP are the biggest.
Yeah, so what I'm saying is next year, this year, another 20-25%. I think you got to ask the economists. And they are, my sense is, one of the things they are missing out, apart from this GVA calculation he gave me, I think, is the wealth effect. See, the direct and indirect tax collection is way beyond their revised estimates. And that is coming from all the speculation which is happening in the market. People are paying, they are gaining in the market, and they are paying the taxes. And those taxes are the ones which are, I think, somewhere after 2-3 years, people will figure out that there were 3 or 4 lakh crores more than what government had budgeted. So I think the power of stock market, and I think that's the differentiator between India and China, and that's the differentiator between US and rest of the world. And that power should be harnessed very well. If you harness it well, we can be $10 trillion market economy in next 4 years or 5 years. And that power should be harnessed. If you don't harness it, it can destroy also.
Okay, all right. I'm sure our audience as well are itching to ask some questions. So anyone, yeah.
Well, Nigel, in fact, I have a guest with me who wants to ask a question. Go ahead. If you can introduce.
Yes. Hi, my name is Dhananjay Bagrodia. I work for Manish Bhai at Enam, now with ASK. Manish Bhai and Ramdev sir, just a couple of questions. So now we've seen like electrification from 50% of the households to 90%. We've seen Jal Se Nal from 50% below to 90%. So we've done the low-hanging fruits. It's a two-part question. Any other segments where you all will see now in 3.0 where you'll see big sectors? And Ramdev sir, since you've been always talking about value migration, any segments where you are seeing something similar happen? I'm not talking about stock specific.
Yeah, so my sense is that the sector of the decade will be capital markets. And this will be benefiting not only from the savings reallocation, but also shift from bank deposits in terms of share, bank deposits to financial markets. So we are going to have it's not a journey of 1 or 2 years, 3 years, but all the capital market companies, and they are very asset-light. The beauty is asset-light. Banking is extremely asset-heavy. So the kind of economic profit you are going to get, the excess return you are going to get beyond the cost of capital is going to be stupendous, and they're monopolistic in character. If you look at these businesses, they're not 30-40 depositories or 30-40 exchanges, 30-40 asset management companies. They're very, very asset management. Top 5 or 6 or 75% of all the assets. So, and you don't need anything. You don't have even a capital adequacy. So I think these are the companies which I think, if you look at 5 years, they look a little expensive, a little pricey, but that's the sector to watch.
Yeah, I don't disagree. I think financials overall is a big theme. Within that, we can keep moving from one horse to the other horse over the course of the next 10 years based on valuations. So I'd agree with that.
Thank you, both of guests.
Okay, we have another question coming in here.
Hi, I'm Milap. I work with tech companies in the US. And you guys spoke about internet-enabled businesses. You spoke about financialization. AI is the buzzword. Do you believe, as I do, that as you go stock picking and beyond the indices, like in the US, that we're going to see a dispersion of companies that are able to build AI models? Is data really the new oil? Or do you think it's one of those blips will go away? What impact will we see in the markets? I would love your take on that.
No, I'm actually, for all the friends, I've been talking a lot about disruptive things coming, and this wave of technology which is coming is true. And the way I think of it, and it may be a useful framework, they're kind of making our brain into a superpower with AI. They're making our eyes into superpower with the use of AR and VR headsets. They're making our energy requirements better, coming from our heart into whatever you may call renewables or new energy, what eventually may lead into EVs and batteries and so on and so forth, but that's energy. For all our limbs, there's robotics, which is coming. And then for our bodies, there is biotech. So 5 very, very big mega themes, which the Indian startup world is involved in. It's not yet in the stock market. So it will be people who are in their 20s and 30s who are going to come with this over the next 10 years. And that's where serious money will be made. I wish I were 20 years younger, so my son does all of this. But that's an interesting space to do. And if we don't catch up, it will be like when we missed the Industrial Revolution 200, 300 years ago. If we miss this wave, because China is way ahead of even America right now in almost all of these. So I mean, that's one example we should have spoken. If we miss this bus, we can get it wrong. Then to get 1 billion people out from Africa into Philippines and then into Australia is a big task.
Okay, I have my colleague Surbhi next to me. I guess she wants to ask a question to both Ramdev and Manish.
Thanks so much, Ramesh. Pleasure listening to both of you, visionaries, market veterans. And I just want to go back and scratch that point that Ramdev ji made on supply. Not that I'm trying to ask unpopular questions about concerns in the market, etc. But just to go back to it, and Manish, your views, the spate of block deals that we're seeing, and there's all kinds of selling. There's promoter selling, there's early investors, private equity selling, then there's FII selling, which Nilesh and the mutual fund fraternities have been absorbing very, very well. But just the amount of selling that's coming in, could that at all become a near-term concern? And this clubbed with a second concern, if I could just add, the mid-cap space, right? The way regulations are, you only have 150 stocks defined as mid-caps. That's your playground. Does that get restrictive? This whole talk of froth and bubble, it really, originated from that space just a few weeks ago.
So let me try and address it. Number one, I think we are all in agreement the valuations are discounting a lot of the future. It's not cheap by any measure. This is a market which is pricing a lot of the optimism. And therefore, it's natural if I was a private equity player for me to book my profit and go. If I'm a multinational in distress, like you saw an American company came and sold down their stake here to solve their balance sheet, or someone from UK came and sold down their large stake to solve their balance sheet problems, it was solving their problem, taking advantage of a situation here. But what I find is this as an encouraging sign that it's a sign of a mature market where we are now concerned about velocity to give us returns rather than extracting margin. If the old way of thinking was high taxes, small number of people and squeeze them. And now we have moderate taxes, large number of people and let the velocity go. Similar to the capital market example. So just the way when Warburg Pincus sold Bharti, way back in 2006, it opened the floodgates to private equity. I think the same thing when you see a SoftBank able to sell, a BAT able to sell, a Whirlpool able to sell. Imagine the electric current running in boardrooms, that there is value creation possible for us in India. And we should not stop our FDI from going here. Unlike other places where your investment in Russia can go to zero. Potentially in China it could go to zero, but this is a place our capital is safe and protected. So I see it as a long-term positive thing. While it may create a short-term hiccup if that demand supply doesn't match for that week. Like I said about investing, on a weekly and a monthly basis, it's a toin cost. But when you stretch that thing out, I think this is a very, very positive development for our country.
Okay, that's the first. The second was this whole concept of mid-caps, 150 stocks.
We have the expert here, Nilesh. He'll take it in his session.
Okay, in his session.
on all the categorizations.
Yeah.
Well, ladies and gentlemen, a big round of applause to the jugalbandi between Manish Chokhani and Ramdev Agrawal. Lots of important insights and, of course, lots of anecdotes. Thank you so much for sharing your journeys. 30 years and 40 years. So cumulatively, a wealth of experience here being shared with us live on TV and, of course, here at the Jolie's Club in Mumbai. Ladies and gentlemen, once again, a big round of applause for our two market veterans. And without further ado, since we are talking about we've talked about the macros, we've talked about the markets, and it is now time for us to talk about private investment and unleashing the animal spirits. This has been the big peeve. Finance Minister Nirmala Sitharaman has been nudging industry year after year to go out there and kickstart investing, kickstart private capex. Are we seeing the return of the animal spirits? That's the big question. And to help us answer those questions, we have a veteran of many cycles in India, Mr. K.K. Mistry. Thank you so much, Mr. Mistry, for joining us. Ladies and gentlemen, a big round of applause for K.K. Mistry. He's here with us this evening. Also with us, Mr. V. Vaidyanathan of IDFC First Bank. Mr. Vaidyanathan, always a pleasure. Thank you so much for joining us this evening. And Manish Kejriwal of Kedara Capital also here with us. Gentlemen, thank you so much for joining us here this evening. As we get started, we heard a little bit from Samiran, and I'm just going to bolster that with some more data that's been put together by HSBC in terms of private investment. And as per the data that they've passed together, the private sector is investing, albeit selectively. And if you take a look at what the data is telling us, that both private, corporate and household investment is higher now compared to FY19. But what is driving that is essentially dwellings, buildings and structures. And that is commensurate with what we have seen as far as the home loan side of the markets are concerned. But without further ado, Mr. Mistry, let me start by talking to you. We were talking about connecting the dots in the past as well as forecasting what the future looks like. We've got very optimistic commentary coming in here from both the macros as well as the market perspective. But unleashing the animal spirits, are we on the cusp of a private capex pickup?
Well, first of all, let me say I'm extremely bullish about the Indian economy. I've said this time and again on various shows. I think India's growth that we will see in the coming decade will be a lot faster, a lot bigger, a lot more serious than what we've been seeing over the last 10 years. And I say this on the back of the fact that the penetration level you see of almost any product in India is so low compared to what it exists in the rest of the world. I mean, if you look at financial services, for example, mortgages are about 11% of GDP. In most advanced countries, mortgages are over 50 to 60 to 70% of GDP. And in emerging markets, they're about 20% of GDP. You take total retail credit to GDP, it's around 18%. US is nearly 100%. So we are so underpenetrated that I think the growth that we will see in the coming decade is going to be monumental.
Monumental growth. Mr. Vaidyanathan, would you agree with the thesis that's just been presented there by Mr. K.K. Mistry that we do see this underpenetration across different categories, across different asset classes as well in our markets? What is driving your thesis for growth in India?
See, first of all, there's a massive financialization and formalization happening in India because of arrival of GST, because of digitization. And as a result of that, that in itself is a huge power that's unleashing in itself. And then when you overlay that on the fact that GDP is compounding at this rate that we're talking about, nominal basis, you can call it about 11%, adding inflation. You put the two together, it becomes a really powerful force.
Since we were talking about markets being on steroids, and as per Ramdev, his forecast is that this is going to be the decade as far as the capital markets are concerned. What does it mean for India's banking sector? You're already finding it hard to get deposits. If it is in fact going to go Nilesh's way, what happens to you?
A lot of numbers are flying around in the past session, so let me add two numbers to set the context in perspective. I went back and studied the size of the Indian credit market in 1994, around the time many of us may have started our careers. And it's crazy. It's 1.7 to 2 lakh crores, which is about the size of our bank today, was the entire Indian banking system in 1994. Okay? It's insane to even think about it. And by 2004, it was about 8 lakh crores. By 2014, it was about 60 lakh crores. And 2024, it is 160 lakh crores. And in the last 10 years, Shireen, India has seen almost every crisis you might have thought about, right? First, there was this, 10 to 14, there was other issues about slowing of economy and all that. Then 2016, there was demonetization. Then 2017, there was GST, which eventually is a good thing. And then 2000, then we saw ILFS crisis. Then we saw the COVID. After all that, GDP has, the banking credit has grown from 60 lakh crores to 160. So our own estimate is, our internal house view, is that even if this compounds at 12% for the next 10 years, this could be like a 3x from now, which is like a 480 lakh crores. So that sort of a big story is coming, and it's only going to be constrained by the extent of deposit growth and not by the demand of credit.
Well, that is the big constraint that I was actually asking you to comment on. But, you talked about the size of India's banking sector. And I think this was a point that Manish was making as well, that if we aspire to get to 8 to 10% growth, is India's banking sector going to be able to fund that kind of growth? And I want to get both you and Mr. Mistry to comment on that. I'll start with you.
So we start with me. So the banking system, just to put again numbers in context, India's net worth of the banking system today is quite strong. It's 25 lakh crores. The banking system making a profit after tax today is the highest in its history of 3 lakh crores. It's a profit that's accumulating as net worth every year. NPA all-time low of like 3.5% or so gross, and maybe net of less than 1%. So basically, and more importantly, the governance conditions around banking system has become very, very strong. So I think Indian banking system is a very, very strong position to support the growth of the future.
But does it have the size, Mr. Mistry, to fund the aspiration that we have?
In my opinion, yes, it has the size. You talked about deposits. Look, these are cycles. If you go back to the last 20 years or 30 years, I don't have the data at the back of my mind, but if you look at the last 30 years, there have been various points of time where deposit growth has been slow, loan book growth has been high, and vice versa, loan book growth has been slow, deposit growth has been high. So this is a cycle. You see, you look at it pre-COVID and look at it post-COVID. In pre-COVID, if you were in a small town and you had 2,000 rupees with you, what would you do? You'd walk to the nearest bank, put your money in the bank account. But with COVID, everyone started having smartphones. Everyone started seeing what opportunities were available. People started, and then you had platforms like Zerodha and so many others which have come in, which give you the ability to trade in the market, and people are seeing that stock markets have done extremely well. So the opportunities for investment for people has increased. It's no longer just bank deposits. There are multiple opportunities. But having said that, savings in India will rise, in my opinion. Phases will happen. There will be periods of time when, for whatever reason, I'm bullish on the stock market, but for some reason, if stock markets were to underperform, you'll again see a flight of money coming back into bank deposits. So I'm very confident that there'll be enough liquidity available in the system to fund the growth that India needs. And I think RBI also has been tight in terms of holding liquidity because of inflationary worries. Once they get a sense, for example, in the current year that the monsoons are reasonably normal, there is no geopolitical issue to worry about, oil is not going to go to $120 type, then I think more liquidity will flow back into the system. I don't think shortage of liquidity will stop the India growth story.
Sharon, let me add one last point to what Keki is saying, just to put that number in context. Even when I said that the Indian credit market will grow from 160 lakh crores to growth, deposits growing at 12% is not really, a fanciful number. So really, if this deposit growth, which is about 200 lakh crores, grows at 12% per annum, the credit of this number of 3x of today, 3x of today can be achieved in 10 years. And that will unleash a lot of power to the Indian economy by that time.
Well, since we're speaking about unleashing the power of the Indian economy, Manish Kejriwal, let me get you to comment on that. What are the themes that you believe will drive growth? What are the themes that you're going to be betting on as far as the next decade is concerned?
Sharon, thanks again for having us here. I just want to start off by saying the big difference that I see when we first started investing in India almost 20 years ago in the Temasek days, and I'll give some comparisons, was, I think it goes back to what Chukani said, right? You believed in the quality of the Indian entrepreneur, just unleashing the energy, which at that time was capital starved, equity starved. Today, that's changed. That time there were very few potential sources of equity, which caused some of the behaviors that you talked about. Today, there's a very viable and a flexible and a burgeoning venture capital industry. There's a growth capital, there's a private equity industry. For the first time, there's a significant amount of exits. So you're giving money back to your investors. I mean, there was a joke when we were raising our fund. What does the word DPI mean? DPI is the amount of capital you give back for every dollar you invested. The story in India by the LPs was, hey, you took capital away, but am I supposed to give it back? That's somebody else, right? That's actually changed significantly. And the markets, thanks to Ramdev Agarwalji, thanks to other investors, today, when you look at large blocks to exit, I mean, KKR exited more than $1 billion of stock in Max Healthcare overnight. That was unprecedented. But if I just step back to your question and see, the other big change, which we used to say in the end of, after the GFC, maybe the early part of the last decade is, we're investing despite the government. They were headwinds, and we say we'd still go out there. I think the big change, though we can't depend solely on that, is that strong headwind has become a gentle tailwind. Right? Are there issues? Of course there are issues. But by large and far, and KK will know this a lot better, but it feels like you're supported. There's the rules, the IBC, or it's the GST. And when you look at the level of, just look at Bombay today. The coastal road, the Trans Harbour, the metro coming up soon. It's 7 minutes from my office to Express Towers. Unprecedented. I want to go back to Express Towers. I don't want to be sitting in Worli anymore. But it's actually a magnificent change that each of us could see. And the last thing I'll leave with you is just the strength of our rural economy and this absolute scale. I think Ramdevji was saying this earlier today. If I was a global investor, firstly, I don't subscribe that all the money is running into India or China shut down. That's not true at all. It's going to take time. It's going to be driven by performance. It's going to be driven by discipline. And if we go into some of the bad habits we had in the past, I think it'll be a lost opportunity. But just to keep this scale, I used to, before we started Kedara, about 12 years ago, we set up the first office of Temasek outside of Singapore, large Singapore sovereign. And there was a phenomenal leader who said, instead of investing domestically, let me sell down Singapore assets and invest in China and India. Very simple thought. But it's taking a megaton tanker and moving it around. One of the first companies we invested was ICICI. I remember Shirin teasing us and saying, what's going on here? Kuch takeover ho raha hai kya? But at that time, if I had two comparisons, we used to compare Singtel, one of our and Bharti. We used to compare DBS, which has done it's done phenomenally with Piyush. We used to compare it with both HDFC and ICICI. I think the ratio in market cap in 2004 or 5 was 15 to 1 or 10 to 1. I mean, I don't even know what the numbers are today, but I'll tell you 10 years from now or 5 years from now, it'll be 10 to 1 or 15 to 1, the other way around, driven. Good corporate governance, basic growth, the fact that housing and mortgages and hundreds of other products. I mean, to me, financial services is the lifeblood of the economy. It's a leverage play on the economy. And if you play financial services well, you're basically playing every sector.
Yeah, well, that is a valid point. But Mr. Mistry, since we are talking about the fact that there has already been many changes, structural shifts that have happened that have provided a much more enabling environment for Indian entrepreneurs. But, the point that Manish was also making, and he talked about the privatization aspect, and in many ways also the privatization of monopolies. As you look ahead, what are the changes in addition to what we've already seen the government do to facilitate 1,000 flowers from blooming?
I think the one reform which probably will get some focus, and I think Manish talked about it, which will get focus after the elections, will be labor reforms. I mean, if we are to really grow, you need better labor reforms. To my mind, that is the one area which is still pending.
But really, I mean, is that a constraint? Are labor reforms truly holding back industry from employing more people?
To some extent it is. But I think also I should tell you that from a regulatory standpoint, the focus that is coming on things like ease of doing business, getting things done faster, I think it is phenomenal. I'm chairing one of the SEBI committees on this, and there is so much of focus, so much of attempt being done by the regulators all over the place, not just SEBI, but all the regulators, to try and make the process of doing work simpler and simpler. So I think easier work conditions, some degree of labor reforms, I think these are the things that will come true in the coming.
So the unfinished reform agenda, what would you put down on the wish list? Of course, the aspiration is that there should be less friction in everything related to doing business and, take forward the ease of doing business even further. But if I were to ask you to specifically list out for us what else you would like the government to do for policy intervention to do to make changes?
See, I think, apart from the very important point said earlier, the small enterprises in India have had a very hard life and a very hard deal. Because the large corporates, because by size, scale, brand, are able to, attract the best talent and get interest at a very low interest, borrow and so on. The small enterprises are still having a tough time, of course made better the last few years, but still hard life. So I think that the tax structure of India being uniform across the corporate sector sometimes doesn't sit well with me. I always say that small enterprises,
low rate of tax?
Low rate of tax means like start at zero tax. You make up to 10 lakhs of income, you pay zero tax. I can tell you this next generation of people want to become entrepreneurs if they are in a tax-free economy. And progressive basis, let them all be like us, like for 25%. I mean, I really wish for this, by the way.
Well, let's see if that is something that the government intends to take up in any form or fashion or not. But Manish, to address your issue and many of the concerns that the VCs have had, private equity has had, with the angel tax and so on and so forth, some issues have been resolved. Many continue. Again, this back and forth on capital gains, whether we will see a review, we won't see a review. We don't know what the answers are. Perhaps we will know this budget or the next. But, what's your wish list looking like at this point in time?
Actually, Sharon, it's relatively simple. I think the known issues are evident to everyone in the industry and amongst the regulators. The reality is the RBI, the SEBI, and the Finance Ministry cannot always be looking at the same direction. We hope they would be. They can't. That's the reality of life. I think this last 5 or 6 years, I would say at least the issues are discussed honestly, and the reasons why they can or can't be done or can be done slowly is also relatively clear. Actually, my only wish list, it's not asking for a much lower rate of taxation or no taxes on ABCD. For me, it's consistency of policy. I don't want us stacking left, right, and left, right again. I would love, for example, this might sound like a heresy, but instead of having an annual budget, to have a budget every 3 or 5 years. Why do we need an annual budget? We just give a longer term direction, policies against it, and we move in that direction. Not very dissimilar to where we might be moving towards sort of elections at the state level and the central level. So maybe that's utopian, but that's what I think is.
Don't do away with the big day for us here on CNBC-TV18, Manish. That's one of the biggest events on the calendar.
But free markets, the current approach of the government of the country is saying that investment in infrastructure, investment in digital infrastructure, free markets, right-wing economic thinking with benefits going down the bottom of the pyramid. If this model changes, we have a big problem. I think it's really in interest to stay this for 20, 30 years to keep going ahead.
But, to be fair, we have seen economic policy continuity, irrespective of whether we have seen regime changes, where, the 10 years of the UPA and then the 10 years of the NDA, we didn't see any significant disruption in terms of economic policy. We have, of course, seen additions like privatization being put back on the table as far as the NDA agenda is concerned, but of course, slow moving. And I don't know whether 400 will necessarily change that. Mr. Mistry, do you believe that 400 potentially could change the course of the reforms that the market has been anticipating?
I don't think so. Whether it's 400 or it's 350 or 450, whatever be the number, I think the focus on reforms will be there. I'm very confident of that. And I think also as we move into the next financial year, and with India now part of the global bond index, both JP Morgan and latter part of the year Bloomberg, you'll see increasing amount of dollars coming into India. And that would give RBI the ability to manage the rupee even more, even better, and it will find a way of flushing more liquidity into the system. So I think all in all, reforms will continue, and the growth opportunities that I see will be there.
But let's tie that down to specific investment ideas and investment themes on the back of what you've already put your money into, and private equity, from healthcare to microfinance, we've seen money coming in everywhere. What do you believe, if you are continuing to be as bullish as you are on the growth story, where do you believe foreign capital specifically, as well as the unlocking of domestic capital, where is that money going to go?
Fair. I think the way we look at life, firstly, I think one of the biggest negatives on the flow of capital would be a more hawkish perspective from the Fed in the US, right? That is the context. I think we're all assuming right now that it's going to get more dovish. Interest rates will come down. It'll be more attractive not to pull money back into the US and spread out the world. Now, once the money comes here, what are you trying to do? For us, the two sectors which seem most exciting, valuations aside, has always been for the last 20 years, financial services and specific sub-sectors within financials. We used to do a lot of lending. We did banks, we did microfinance companies, we did pure lending from NBFCs. Increasingly now, if you look at insurance, health insurance, general insurance, or asset management, from what Keki said, where the mortgage market shares are, it's even smaller. So the growth is that much larger. Right? Second, for us, has been consumer and consumer tech. Vishal, which he mentioned, is a great example of a company which we bought 7 years ago. It's grown. It has a PAT of more than 500 crores. It'll be a blockbuster IPO whenever that happens. Right? And the reality is we're being rewarded by the markets and providing exits to our investors. That is the constant. You have to be disciplined in our industry. At the end of the day, it's not our money. We're simply a proxy for a bunch of global family offices, pension plans, and the others. So it's based on performance. And then, interestingly, a lot of tech services, and healthcare and health services. But my overall theme in all this is the penetration level. The opportunity is huge. Where we have to be careful to avoid mistakes is in private equity, it's bottom up. It's to avoid a bad governance. It's being able to see, it's being on the ground, feet on the ground, and you'll see the returns coming.
Well, that certainly is the hope. But Mr. Mistry, we were talking about the investment engine, but also on the point of the consumption engine, and we've seen disparity there. At the top end, I mean, things are flying off the shelf like we've never seen before. At the bottom end, the pain continues. What is the forecast? What's your own prognosis about when we start to see convergence?
My sense is after the elections, because if RBI is confident about the way the monsoons are panning out and there is no geopolitical risk or geopolitical risks subside, I think you'll start seeing interest rates coming down. So I've seen many analysts talking about cutting rates.
Samiran says October, nothing before October.
I'm not so sure. My personal view is could be before October if the monsoon outlook is good and there is no geopolitical issue. I think it could be before October. See, you have to look at it from the perspective of a lower middle income person. Let's say he's taken a loan in 2022, a housing loan in 2022. The interest rate on that loan at that point of time was 7.5%. Rates have gone up by 250 basis points in the last 1 year. So this individual is now servicing that same loan, not at 7.5%, but at 10%. Yeah. The difference between 7.5 and 10 is 33%. So his cost of servicing the loan is up by 32%. So these kind of things have impacted people. But I think liquidity will flow back, interest rates will come down, and therefore I would be reasonably bullish to say that the consumption will also pick up, even the low-end consumption will pick up. High-end consumption, expensive real estate, a lot of that is linked to the stock market.
Yes, and the wealth effect that Ramdev was talking about, but a rate cut? Wait till October, pre-October. When do you see that coming in, Mr. Vaidyanathan?
Well, you heard all views are are all house views somewhere in between. But the thing is that we should really look through the cycle. You know, at this point of time, the bigger issues to watch out for. Really, interest rate is a cycle.
Like what?
It'll go up and down. Bigger thing is to watch out for is discipline. You know, the fact that the way you're having this conversation around, everyone is so bullish about India.
That's a problem, is it?
No, it's not a problem. It's a good thing because it brings out the spirits. But at the same time, you know, it just brings on us we need to have the discipline to not gorge at things and
so the RBI nudging banks to look at credit deposit ratios is a way of the regulator sending a signal to banks, and banks, quarter on quarter, if you look at the numbers, clearly the banks have taken the message.
Yes, they have, and they should, because end of the day, the regulator has seen so many cycles, and we respect their wisdom. And therefore, you know, this commentary coming from RBI asking people to slow down and calm down, I think, of course, I agree, it's a good message.
So how much more calming down is needed, or how much more calming down should we expect?
No, the thing is that, you know, the key thing is that to stay in control and still grow will make this a sustainable story for the next 20, 30 years. You know, like someone said earlier, we shouldn't crash and burn. So I do think it's a good thing. And
is that, I mean, what the odds of crashing and burning at this point in time? And we've already seen the regulator come in on unsecured loans, come in on credit deposit ratios as well. Is the fear of crash and burn a palpable fear today?
Well, on the ground, the truth is that the credit behavior is really very good. You might see an optically the credit cost going up in the next financial year for most players, and that's because the fact that, you know, when you do like year-to-year comparison, you got recoveries last year, not getting a recovery this year. Technicalities apart, the fact is that at the grassroots level, the consumption story is strong. India's personal credit to GDP is very low. It's still 17 to 18%. US is still at 70, 80%. So it's a big story, like Keki pointed out. The fundamentals are very strong. But to the point we said earlier, to have the discipline to work within the guardrails is really very important. I think it's a good thing message coming, and I think everybody's hearing the message.
Everyone is hearing the message. Mr. Mistry, are you worried?
No, I would add a little bit to what Vaidya said. I think firstly, we must compliment RBI for the measures that they've taken over the last 5-6 years. The way they handled the economy during the COVID period, not just flushing liquidity into and the government also, of course, government and RBI, not flushing liquidity into the system, letting inflation get out of control, all extremely well managed. The balance sheets of balance sheets of the corporate sector today are a lot less leveraged. Significantly less leverage than what they used to be in the pre-COVID days, which means that the quality, the asset quality of the banking system has clearly improved significantly. And I think the last number I saw was 3.2 or 3.3% gross. And I think, as Vaidya said, net is under 1%. So all in all, banking system is strong. Leverage level is low, but the RBI has to be watchful, has all the time to make sure that there is no possible risk that is coming into the system, and therefore the measure they took in November when they increased the risk weight on unsecured loans. So you may see some of these things happening. This is not that there is a problem in the system, it is to preempt any problem happening.
Yeah, so being vigilant at this point in time to calm things down in your words before things get too hot or out of hand. I am going to throw this open now to Mangalam and Sonal for questions from our participants as well. Mangalam, over to you.
Well, you know, this was incredibly insightful, and the thing that stood out for me, and it could perhaps mean a full circle as well, Manish, you said that when you were looking to invest in India, you looked at some of the Indian listed companies, compared them to global companies, and saw the ratios were much in favor of India. But now as we speak, you know, the CEO of Whirlpool recently said that they're doing a valuation arbitrage with India, where they're selling the Indian stock to buy the global stock. So how do you justify those valuations?
No, listen, I think ultimately, when you look at valuations in India, and each one to their own, right? But it's driven, people are focused on revenue parameters, profitability parameters. People forget the whole concept of ROCE and ROIC. How efficiently is the capital being deployed? I think a Whirlpool or a BAT or a Unilever does what they have to do. They have significant corporate priorities. They see, it's no different than our promoters selling the underlying OpCo and buying a discounted HoldCo. right? So you do the same thing in a global market. You'll sell the BAT subsidiary here, which is ITC, and buy more. That is their board's discussion. I think if you look at from a risk-reward perspective, is how global allocators look at equity. They say, okay, there's a certain amount of capital that we have which we need to make returns on. Where are we seeing the growth? Where is there a large market? There was a concept some Goldman guy came up with called BRICS. I mean, where is BRCS today? There isn't, right? Now, I'm not a blind Indophile to saying all money would go into here, but today it's difficult to avoid the country, right? I think in the past there were historically issues, whether regulatory, whether transparency, a huge amount on governance. I think at an average level, and both Vedi and Keki see a lot more corporates than we do, but I would see the average level of governance has increased tremendously. And it's not that people have suddenly become better. Promoters themselves realize, agar theek karoge, you'll get a better multiple for your company. So I think in a sense, it's horses for courses. So global companies should do what they have to do given their priorities. But as far as the India story is concerned, I think the decade is yet to start.
I just add a little bit to what Manish said. One is when you're looking at valuation, you have to look at valuation in the context of the growth. The growth opportunity that you will get in India, and you talked of financial services, and I completely agree. In my view, financial services is where the growth will be the maximum. The valuations are not that expensive when you look at the growth possibilities that are there. That's one. And secondly, to just reinforce the point that Manish made, which is at the governance level. We see this all the time. In 1980 or 1985, when you used to lend to a company, governance, honestly, in many cases was a big issue. Today, when we lend to companies and we see how much focus these companies are placing on governance, because they all realize that if they are well governed, they are perceived to be well governed, they'll get that valuation, they'll get that, markets will be interested in them.
Well, that certainly is the governance premium playing itself out. Sonal, over to you.
Well, there are a lot of Gen Zs and millennials in the audience as well. And one word that is the buzzword is entrepreneurship. Everyone wants to do something new. Everyone wants to earn a lot of money. In that case, Manish, tell me, what is one sector or few sectors which you think are untapped in India right now, which have a lot of potential, but we have not seen it yet there?
Listen, I am not an early stage venture guy, which is cool and fancy. We're like boring, smokestack, industrial. We don't look at companies that turn...
You're calling yourself boring?
I am. But the reality is, you can take almost every sector and subsector. Take financial services. The amount of stuff going on the fintech side, it is fabulous. And and if I look at consumer and consumer tech, we have a small company called Purple we've invested in, which, at least in the rural areas, beating the daylights of the market leader, who happens to be a very good friend, so I won't use the name. But you're seeing but I think the reason for that is different, Sonal. It's because the old fallacy of, agar company kharab ho jayegi, barbad ho jayenge, and we'll never be able to start another company. I think that's the mindset change that has happened. And frankly, for us as private equity, a lot of the investors, and I mean this seriously, is essentially first and second gen entrepreneurs who are not able to convince their kids to go into the smoke-smack industries that they had started in the 80s and 90s. And we are essentially not solving an investment problem, we're solving a succession problem. And good luck to the Gen Zs for all the ideas they're creating. And I think the two is, one is this, there's no longer a shame for failure. Secondly, the availability of capital. Okay, there's a bit of this thing called the funding winter and all that, but that also, it's a short time thing. It's the last 2 years because there were excesses. It's probably a good thing we had a funding winter. Now we'll have some funding. She'll come up with a funding spring or a summer, right? It will happen. So that's a cycle across the time. To me, the best part of this is no bad points for failure. You can do it and try it again. And availability of capital, which are the two biggest sources of the entrepreneurial juice in India.
Okay, we totally take that point, but we do have a lot of people in the audience who would like to ask some questions. So please go ahead. Anyone who would have any questions?
Raise your hand.
Yes, please raise your hands.
We have Prashant
Oh,
here.
yes, please go ahead.
So, hopefully, say 10, 20 years from now, when we do the 50th year of CNBC-TV18, we'll have some of the new age entrepreneurs sitting like you all and talk about the business.
Certainly not us.
You'll be there. You'll be there till the end of the time. But, Prashant here makes a lot of money when corporates make a lot of money. So he has a question about the animal spirits, the return of them.
Prashant makes the money irrespective.
So I have a question for Keki in particular, but also relevant, and I would like to hear the answers from both Vaidya and Manish as well. One very specific question. Obviously, in financial sector, like in other sectors, over time we've had ownership restrictions, like in insurance, starting with 24, then 49, and so on and so forth. In banks also, there has been a 74% restriction. I would like to hear from you what have been the benefits of that, and are we at a time that we should reevaluate that restriction?
In my personal opinion, honestly, I mean it, I think we should relook at it, because in any case there are governance norms. RBI has laid down limits that no individual shareholder can own more than 5% or in certain cases 10% of the equity of a bank. So there are checks and balances which are already there in place. But if you just change that 74 to 100, the amount of additional money that can come into India.
100+ billion.
Exactly. So huge amount of money can come in, not necessarily directly in equity, but through these passive funds. Because the weightage in the MSCI would increase significantly.
And I might just add there, much larger would be the inflow from active funds as the weights in the indices go up.
Yeah. Active, yes, but I'm saying even active apart, passive also.
Anybody else wants to chime in on that?
Nothing, since insisting on my comment. See, when we talk of India's $35 trillion economy in 2047, right? Imagine even if the same credit to GDP ratio at that point of time, India will need a credit so-called book of at least, say, let me say, $25 trillion. And for that, you will probably need equity of maybe about $2.5 to $3 trillion. So we should therefore make a policy in such a way that attract that kind of capital. And I do not think all that capital can come from India through domestic sources alone. And therefore, we should always be conscious that of our capital requirements, and without capital, you will get strangled. And this is something we should be aware. And our policy should gear to be able to originate foreign capital additionally to be able to meet that demand of credit for the country and take a GDP there. Otherwise, your GDP will actually not get there because you won't have the fuel to get there.
The only thing I'd add, Prashant, is there were regulations at a certain time for certain reasons. I would say two things have changed since then. The Indian let's take insurance. It's been 20 years. We have, they needed actuarial data from other places. We have that now. And I think the companies are strong enough to stand their own. And I would go with Keki that absolutely all restrictions should be relooked at, not for the point of attracting foreign capital. Both foreign and domestic capital will come. My only point, and it's a larger point which I like just stating out there, is from a regulatory perspective, sometimes the rules today are made to catch the bad apples, right? Often what's going on with the rules is the baby gets thrown out with the bathwater, right? So one should just be careful as we're open. We should open up, but also as we construct new rules to prevent bad behavior, it doesn't become as restrictive so that the green apples don't become bright, rosy red apples, and they're filled at the bad ones.
So, ladies and gentlemen, we do have Prashant coming back up on stage in just a minute. But before I let the three of you go, and thank you so much for an insightful conversation, I'm going to start by asking each one of you 10 seconds each. We are talking about the decadal dividend, Mr. Mistry. So, what will be the preferred engine to your mind? Do you believe that over the next decade we are going to see the consumption boom, or do you believe that it is going to be investment driven?
I would say both. Consumption and investment. We've seen a lot of investments coming in the last several years. This year, consumption has been slow. I think consumption will also pick up. So in the next decade, you'll see both investments and consumption growing at the same pace. So that will give that double momentum to the economy.
Same pace? Do you believe that we are likely to see the convergence?
Well, Keki has already answered that, but I'll just give you another perspective to that. I think that the really key breakthrough India will achieve over the next 10 years, since we're talking decadal here, we've done financial inclusion at a reasonably good pace in the last 5 years, or maybe 7, 8 years. But I think the big story of the next 10 years is going to be credit being available to the lower end of the economy, because thus far it's already been the large corporates who always got the credit. And I think that's, we talked of animal spirits. We always think of animal spirits as large corporates, all the, billion-dollar companies. But the animal spirits are sitting there below, and that firing will happen in the next 10 years.
And hopefully that credit gap, the yawning credit gap, at least as far as that constituency.
And will be great for many banks, including for us, of course.
Of course. That's what you're hoping for, Manish.
I don't know if Vaidya is looking at his bank's balance sheet or a future in politics, but it seems to be going in that direction. But it could be both. But I think without investment, you don't get consumption. I actually think the only thing I'll say in a slight subtle shift to Keki is, I do think if you look at this from a 50-year story, the next 10 years should be 75% investment and 25% consumption. If it's a 10-year story, it's half-half. But I really think what we're seeing today, and I mentioned that earlier in terms of the Mumbai being only a small token of the landscape, when you're seeing 35 airports, and you see Mumbai airport and you go to Heathrow and you wonder which is the developed country in the traditional sense and the developing country. So I think our massive years ahead, I do think we need to put more in to reap the fruits in the future.
Well, we hope that we will see more being put in on both enabling an environment to allow not just the large corporates to flourish, but also encourage the small and medium enterprises, which really are the backbone, especially as far as job creation is concerned, to do better. We hope that there is convergence and there is that yawning credit gap that we spoke of, that is an issue that is addressed. And some of the unfinished reforms that we spoke of, we do hope that those are taken forward as well. Keki Mistry, V. Vedanath, Manish Kejriwal, appreciate you joining us here. Thank you very much for your time. Ladies and gentlemen, a big round of applause.
Thanks very much, Shireen. Thank you, Manish. Thank you, Mr. Mistry. Thank you, Mr. Vaidyanathan, for a really sort of insightful discussion. I think, optimism is infectious, right? And I think what we've heard so far is a fair bit of optimism, but it's, of course, not unbridled. It's measured. And I think it's something which spreads. And I think optimism is necessary not just in stock markets, but of course, when we're talking about the investment cycle as well. And some of the comments really I think, point to that. So we cannot end this evening, of course, without talking about markets and what to do, right? We've mapped the macros. We've heard from corporates. We've had a nice jugalbandi between market veterans. But I think we'll also now spend some time talking about what to really do. What are the actionable ideas that we can put before you? To do that, I've got three gentlemen, so let me just invite all of them onto the stage. We have Prashant Khemka, who's of course going to come up on the stage. Anish Tawakle is Deputy CIO at Equity at ICICI Pru AMC, and Nilesh Shah is Group President and MD at Kotak Asset Management Company. Thank you very much, all of you, for joining us.
I was following your footsteps, I didn't realize it.
Thanks once again. I must say that between the three gentlemen here, they command a firepower, equity firepower, which is doing the rough numbers, some $90 billion US, 90. So that's some serious money that we're talking about. Nilesh bhai, I want to start by asking you the first question. At my home, in my building, in my complex, when I go outside, and I'm assuming that we have lots of, Guju friends here. You are one. I get asked this question a lot of times. क्या लेना चाहिए? मैं आपसे पूछना चाहता हूँ क्या लेना चाहिए? And I know the answer by India, so that will not do.
So Prashant bhai, first let me start with a disclosure. Mutual funds are not taking any money from banks. When I receive money, it is by check. When I give money, it is by check. As per RBI's own data of financial flows of household in last 3 years, only about 1 lakh crore has come into equity. Only about 4 lakh crore has come into mutual funds, including debt mutual funds. About 9 lakh crore has gone into currency notes. Mr. Vaidyanathan, you have to fight with the currency notes. from your branches, you are disbursing 9 lakh crore worth of currency notes. This is depreciating Ashad Prasant Bhai. And yet, bankers keep on giving 9 lakh crore worth of currency notes to people. They are at 31 lakh crore of retail financial household. हम लोग तो 4 लाख करोड़ है. कोई competition ही नहीं है हमारी. हम तो वो currency note वाले से लड़ रहे हैं. Hopefully this debate is settled. Thank you.
I'm sure Mr. Vaidyanathan will have a question. We'll open up the floor for that. But to that question, Nilesh bhai.
So now, yeah. Prashant bhai, we have reached a level where my cousins are telling me, Nilesh bhai, aa lai lo, kale vadhi jase. And it actually goes up. So I am at the receiving end, and I'm sure in audience everyone has made far more money than my funds have made. So I'll take their advice.
But that is a dangerous one. We often hear, right, the old story, when the panwala tells you what to buy.
So as Vaidi mentioned that SME should have lower taxes, Vaidi, you must have told this to SME exchange IPOs. They are already discounting it.
Okay, I'll come back to you, Nilesh bhai, in just a bit. But Anish, what's just that question? I mean, what to do in the market scenario, which has done so well. The run-up has been phenomenal. We are basically making new all-time highs. The corrections and the falls which come, they're short-lived, they're sharp. Not sharp, actually, they're shallow. And very, very short-lived. 2-3 days, 2-3% of the market sort of moves back up once again. So what is the thing to do?
So the way I'd frame it is like in the markets, you get returns from 2 sources. Either multiple expansion, the PE multiple expands, or you get earnings growth, right? I don't think anybody would argue at this point that multiples are cheap and multiples should expand further. They might, but I wouldn't bank on that, right? So really what you have to play for is earnings growth, right? And earnings growth then depends on what happens in the economy, right? Now, I'm of the view, and I think I share that with everybody else, that the economy is likely to do well over the next 2 to 3 years. So if the economy does well over the next 2 to 3 years, the sectors that will do well, right, the increment normally comes from the cyclical sectors, right, the domestic cyclicals. So these would be things like automobiles, financial services, cement, and capital goods. I know they've done well already, but if there is likely to be a positive earnings surprise, I would still play these sectors.
Anish, I mean,
I'll make one more point.
Yes,
Between
please.
large bid and small cap, our view is that risk-return trade-off is clearly in favor of large caps at this point.
Nilesh bhai, you'll agree with that? You've been sort of advising caution for the last 2 quarters at least. We had a correction, but very short-lived one.
So we have been way early, and thereafter markets have risen a lot. But I think what is worth avoiding also is important. The low floating stock counters are today trading at crazy valuations. And it will make sense to stay away from there. It might give you short-term pain because momentum can still continue to ride. But in the long term, this will benefit you. So just stay away from low floating stock, high expensive valuation counters.
But do you agree with Anish's point, the skew has to be large caps? I mean,
undoubtedly, yes. Right now, the risk-return trade-off is more towards large caps and larger mid-caps.
Prashant, come in there. You have a sort of global, you manage global money and Goldman Sachs. You've $8 billion of assets under management now. A lot of it is foreign money. What is the perspective? I mean, and you're getting money. You're still getting money. So where do you deploy?
So we remain fully invested at all times. Even today, cash in the portfolio might be 10, 20 basis points, not even a percentage point. Valuations, if you look at relative to India historically, we are not in the camp that they are, forget outlier, but last I saw, it is in line with the last 10-year average at the market aggregate level, at least as of month end, and I don't think March in particular, Feb, and I'm talking about, I don't think March in particular would have. And so I'll give you a precise number from what I recollect. It's at 20.7 times is the last 10-year average forward 12 months, and we are at 20.5 times. So if anything, a smidgen below. There are pockets. Nowadays, obviously froth is oft mentioned word. So there are pockets of froth in small caps, but at an aggregate level, neither in large, nor in mid, nor in small, we never make that call that small is better. My point usually is that it's hard enough to identify a undervalued stock. to be able to talk about in aggregate entire segment of the market being overvalued, we generally don't make those forecasts, and we remain as always. The stock selection opportunities are often the best in the most inefficient segments of the market. They always tend to be mid and small. So that overweight, over-allocation continues to be in mid and small relative to large at this time.
So that's a bit of a slight difference, right, compared to how you are allocating money right now. I'll come to specifics and what sectors make the most sense, etc. But, we heard Manish talk about, and Ramdevji spoke about 5 trillion, 10 trillion. Is there a need to pull back a little bit? Because sometimes we are looking at, I think Manish made that point that, when you look top down, you can make a bearish case, but you then study individual businesses and you see great opportunity, right? So it's not maybe a like-to-like analogy, but is there a case to pull back a little bit? And I mean, if we're really at that moment where the decadal dividend, so as to speak, is to come our way, does it make sense to pull back and look at the bigger picture? Or will that be getting carried away? Nilesh bhai.
So let me give you answer in a philosophical way, and Anish and Prashant can give on a more financial way. Do you believe there is a God upstairs? I mean, you can see hardly anyone nodded. Now I'll prove to them God exists and he or she is an Indian. So let's look at oil prices. Israel-Hamas war, oil production cut by Saudi and Russia. Russia-Ukraine war, Red Sea disturbance. Oil should have been in triple digit. There is God which said Tathastu, it is in still double digit. US Fed 3 months ago was saying higher for longer. God said Tathastu, now Fed chairman is saying I'll start cutting rates. Karnataka election, we were worried about government. If I make a statement here, ab ki bar, people will say, bhai vote karna. 400 par. Vote on account, we were worried about it will be freebies laced election vote on account. It was the shortest speech. I normally go to CNBC Awaz every budget time. We were villa for 1 hour. You look at monsoon, last year was below average. This year God said Tathastu, it is becoming with La Nina rather than El Nino, so it should be good enough. Look at the GDP growth number. We started at 6, we are ending the year at 8. We do go wrong on such estimates, but not by 25% margin. Do you believe there is God upstairs and who is an Indian? If yes, then play like Sunil Narayan played yesterday.
But you're making my point, Nilesh bhai. So then, then what I'm saying is correct. You need to pull back a little bit and not get fixated on.
Yesterday you didn't watch Sunil Narayan betting. Uske tarah betting karo because upar wala sambhal lega.
Is that in jest or is that serious?
No, I have many other points, but let them give the finer real points.
Anish, to that point, you look at valuations, you look at not the near term, but the next 1 year, 2 year. That's what we do. We look at earnings forecast, maximum 2 years out. But is there any case, and can you invest that way by pulling back a little bit and sort of riding on some of these mega trends, mega themes? Valuations have always been rich, and maybe they're a little richer now. But so what, Anish?
See, I actually don't take very strong 10-year views. There's always a very wide range of outcomes possible. I believe Indian economy has great potential to do really well, but we should evaluate in 2 or 3 year periods, right? I think there will always be cycles, there will be periods of booms, and there will be slumps in those 10 years. At this point though, over the next 2 or 3 year outlook, at least if I look at the economy, it looks very robust, right? And there are, actually I track 4 variables in the economy. One is cement consumption, second is automobile demand, third is home sales, and fourth is power demand, right? Frankly, these are the only 4 variables in which you get hard, reliable numbers. Everything else, rural wages, etc., the numbers are, you can make what you want to make of them, right? So from a cyclical perspective, all these 4 numbers are strong, right? If I look back, over a last couple of decades, There have been periods where these numbers have looked strong in the past, but what went wrong, right? Home building is very, very critical. And if you see this cycle, this pickup started when real estate market unfroze and activity started picking up. If I start seeing that house prices are appreciating, but house volumes are not coming through, which is what happened in 2008, right? People were very happy that house prices were appreciating, but actually buildings were not being completed, right? Then I would get worried, right? At this point, what I'm seeing is very strong home building activity with volumes. There are price increases. I don't necessarily like that, but at least volumes are coming through. If I see, look, cement capacity utilization has reached at a peak, or if power capacity is now fully utilized, then I would say, look, the cycle has peaked. I'm not saying the long-term outlook has changed, but the cycle has peaked. So, but at this point, I don't think we are at the peak of the economic cycle.
There's a lot of new supply also coming, right? Samiran was earlier making that point. That,
which is good, which is good. So that means you'll have a longer runway. Yeah. If you don't have capacity coming on, that's when demand exceeds capacity.
Correct.
And you get the risk.
Prices go up, but volumes, units don't go up.
Exactly, exactly.
And as you said, real estate is a crucial cycle, and we asked this to developers. What year are we in the cycle? I mean, if it's a 7 or 8 year cycle, are we in year 2, year 3, year 4? What's your sense as an investor?
Look, real estate, I give this statistic about India and China. A lot of people talk about manufacturing in China. Actually, the bigger story was actually urbanization and home building. If you go back to 1981, the proportion of people in urban areas in India was slightly actually higher than China.
Right.
If you look today, the total population is the same. There are 900 million in urban areas, we're 900 million in rural areas, right? So what they've done really, really well is urbanize and home build. Now, I can't actually say how long this cycle will last, right? It depends on whether urban infrastructure is created. If urban infrastructure is created, you could have a very long cycle, right? So I wouldn't necessarily say it's 7 years. It might be shorter, it might be longer, right? I think you have to play it on a 2 or 3 year basis, like on an ongoing basis. You have to keep reevaluating.
Got it. Prashant, any sense in taking slightly longer view here?
Yeah, I would say yes, absolutely. And we've been emphasizing quite a bit on growth and how it, stacks up to the valuations. But very important, I believe more important than growth, what the market values is governance. In any sector, anywhere in the world, you just take, and I'll talk about it more at a stock-specific level as well as country level, because both are equally important in India's case. Let's take, within this panel and the prior panel, we've had 4 panelists from banks. So let's take banking as a sector. Yeah. Where else in the world, I haven't seen, and I've invested in every country almost over the last 20 years, starting from US, small caps, large caps, and EM, we still manage EM currently. I scour EM landscape across the world, from Korea to Mexico. Nowhere do you find governance and transparency in banking sector that you have in India. Okay. Within India also, Nilesh Bhai's bank has not generated in the last 20 years the fastest growth nor the highest ROE, right? But has consistently traded at the top of the pack by multiple. Why is that the case? Why not the fastest growing financials have been at the highest multiple? It's not the growth that determines the multiple, it's the governance that determines the multiple. And ICICI is up there with multiple as well. Yeah. So that's at corporate level, and banking is the largest sector, 25 to 30%. It has a huge bearing on the multiple of the entire index. Just simple math, in China also 25% is banking. They all trade at 0.5 multiple or 5 PE multiple. Here in India, they deservedly trade at 20 multiple. If in China there was a bank as transparent and well-governed as an Indian bank, it will trade at 40 multiple because there's nothing else to invest in the banking sector over that field. But 15 multiple points difference on PE. Multiply that by, let's take 30% of the benchmark. That itself contributes 4.5 multiple point difference between India and China. We're just talking about one sector. Now this is at stock or sector level. At country level also, we've done considerable research, our team. Going back 25 years, democracies have always traded at a substantial premium to authoritarian regimes. And when you think a little deeper, It's because in well-functioning democracies like in India, there's separation of powers, there's judiciary, and there are proper property rights, contractual rights that get respected. When I travel to, UK, and I make this point, they talk about Vodafone case. I'm like, okay, what happened with Vodafone case? They weren't happy with the position that the government of India took. They sued the government of India in India, right? Without any fear of vindictive behavior from the government. Can they, how many emerging markets can they do that? Can they sue the Chinese government in China? I won't name each country, but yeah, the ability to sue the government in their own country and yet be able to do business without the fear of existential fear commands a huge premium. And then that is what is the number one reason I believe India trades at a substantial premium compared to emerging markets. Growth is certainly the other factor. But number one reason is governance at the national level. And second is also the governance at the sector by sector, company by company, if you look at, is very strong governance.
Thanks, Prashant. That's a very well-rounded argument that you make. One sector or one area that all three of you are very bullish on is domestic cyclicals, industrials, capital goods, that part of the segment. And that's largely over the last many years been driven by government spending. And we just had a session talking about it, return to the animal spirit. It's the private sector making a big comeback. But while we wait for that to happen, we are in election season now. We'll get manifestos very shortly. And maybe they'll be well detailed with what the next agenda, etc., is going to be. Nilesh Bhai, but do you think that is the one segment, infrastructure build out in a big way, manufacturing, import substitution, that continues to remain the big area of opportunity led by government spending? What's your view?
So one, this is our golden opportunity to capture China plus one. In 1980, we were equivalent to China. Today, they are 6 times bigger than us. What we lost, we should recapture. One, there are 2 areas which makes India's manufacturing uncompetitive. One, logistics cost, second, power cost, apart from many other things. When we had PSU market cap of 15 lakh crore and a deficit of about 3.5% to 4%, our divestment program was about 65,000 crore. Today, when PSU market cap is 50 lakh crore and fiscal deficit is about 6%, the divestment program is 50,000 crore. Undoubtedly, there is a room to increase divestment. We should use that divestment additional receipts to ensure that we become productive or competitive on power cost and logistics cost. Today, industrial power carries the subsidy of agriculture power. I hope and pray that some political party will put in their manifesto that we will use divestment to ensure that industrial power is free of agriculture power subsidy. The second is the commercial freight, which carries the subsidy of passenger fares. The last railway minister which proposed increase in passenger fare hike, he was sacked by his own party, and thereafter no railway minister ever attempted that. Again, use divestment proceeds to take out subsidy of passenger fare from commercial freight. You take this over a period of time. You can't do it in 1 year, understand that. But over a period of time, and let Indian manufacturing become competitive to the world, go and capture China plus one. In 1 minute, I'll say what we have missed and what we should not miss. Samsung came to India long before they went to Vietnam. They are today India's largest consumer durable company. They have done very well over here. They run India, world's largest single location mobile handset manufacturing plant in Noida. But they went to Vietnam much later after coming to India. They make in Vietnam to sell all over the world. What's their turnover in Vietnam? About 6 lakh crore. It's 6 times higher than India. Is Vietnam 6 times bigger than India? No, it's 1/12 size of India. They contribute about 28% of GDP in Vietnam. Imagine if we had not allowed Samsung to go to Vietnam and kept them in India by providing all incentives and making our manufacturing competitive, where we would have been. We should not let that ever happen.
Some of that enabling sort of environment is getting built now, and I think many companies like Apple, etc., want to make a lot more here in India. Anish, same question to you with regards to looking ahead in the, opinion polls, etc., all suggest that the BJP, the NDA will come back strongly. If that is so, do you think infrastructure, build out and make in India, those will be the big buzzwords once again?
So I'll put it this way, we put a lot of emphasis on structural reform. Actually, what has worked really well over the last 10 years is actually the cyclical management of the economy. What do I mean by that? When the private sector was not spending, when the economy was in a slump, that's the time when the government should step in and spend. Right? Fiscal policy should be counter-cyclical. Now, when the private sector has started spending, and I'm not just talking, I'll come to what parts of it are spending, but if you see cement demand is good, automobile sector is picking up, the government needs to scale back its spending, right? So fiscal policy should also be counter-cyclical. And what I really am happy to see, right, is that even though we are at this stage in the political cycle, fiscal expenditure has not gone out of control. And it's actually very tempting to do that because when the economy picks up, your tax revenues grow, and you feel, oh, you are entitled to spend. But actually, when the economy picks up, you should be the government should be cutting spending. So I would not want a big spending boost from the government at this stage. Infrastructure, urban infrastructure is important. That should get built. If urban infrastructure is built, home building will happen. People will build homes, right? And the investment cycle will pick up once people build homes. The only one point I'd make, right, there is no inherent merit in exports. You ultimately need exports because to pay for your imports, right? There's no inherent merit in them, right? And I actually don't think Indian manufacturing has done badly. If you look at pharmaceuticals, 1/3 of the drugs consumed in the US are made in India. We export automobiles, right? So the point I'm making is the external account is in balance. We want to attract capital into the country, which by definition means we will run a current account deficit. That's mathematical, right? Once we run a current account deficit, we'll be exporting some stuff, we'll be importing some stuff. We are very good at services, so we export services and we import some manufactured goods. It's not the end of the world. I don't worry about that. Manufacturing will grow if house building grows. If people build houses, somebody was talking about the statistics of air conditioners. Yeah, but you need houses before you can have air conditioners.
You're saying a push towards urban infrastructure
will drive manufacturing.
Okay, will drive.
Urban infrastructure will drive home building, which in turn will drive manufacturing because there will be domestic demand.
And that is, of course, a huge, long value chain, right?
Exactly.
Consumer durables, of course, as well. In that chain.
Absolutely, right? If you, today, you have cars and you have automobiles produced in India because those are like cars, pharmaceuticals, these are things that don't depend on the size of your house. Right? You park your car, you park your two-wheeler outside the house. Everything else depends on the size of your house. How many clothes you can consume, how many shoes you can buy, depends on the size of your house. So if you get urbanization right, if you get home building right, manufacturing will follow. People will build if there is demand for it.
Right.
Is my simple point.
Prashant, very briefly, same question to you. What's going to be the agenda and the investment implication then?
I think I agree that the focus on, it's reasonable to expect the focus on industrialization and infrastructure build out would continue. I would just add that over the last 5-10 years that we've seen this pick up has been aided by the improvement in soft infrastructure as well. So what I mean by that is ease of doing business. We went from 142nd to 62 the last time that was published, and maybe by now we are something like 25, 35 or something. But we should continue, relentlessly on that front. We would not accept to be 25th best cricket playing country. And with same kind of, attachment with ease of doing business, we should continue on that path. And that is what then enables physical infrastructure build out as well.
Gentlemen, I have a lot more questions, but we're out of time. So thank you all for joining us here on Chasing Alpha. I dare say, for the last couple of years, Alpha has been chasing us. And I just hope that situation continues. Nilesh bhai, Anish, Prashant, thank you very much for joining us with that enlightening chat. Shireen.
Thank you, Prashant.
Once again, thank you very much, gentlemen, for joining us here on the India Exchange. Ladies and gentlemen, what a fabulous evening it's turned out to be. I hope you've enjoyed it as much as we've enjoyed putting it together. You know, the idea of India Exchange, as I pointed out, was to encourage an authentic, intimate conversation. I think we've truly had the pleasure of watching so many of our guests here deliver and do exactly that. We look forward to seeing you all again here, hopefully, in a few months' time as we bring you another edition of India Exchange. But, you know, if I could sum up what we've heard from our guests this evening, I think the job of leadership really is not just to defend the present, but it is to attack the future. As everyone has pointed out, that is India's opportunity. It is now, and that is the hope and the aspiration that people do have from leadership, whether it's the government or it is corporate or it is markets. But many, many thanks to each one of you for joining us here this evening. Ladies and gentlemen, do join us for drinks and snacks, and many thanks to the team at Jolie's for being so generous with providing us this venue. It's been wonderful to host this event here, and we look forward to many, many more here in Mumbai. Thank you very much, ladies and gentlemen, for joining us here this evening.
CNBC-TV18 India Exchange.